Valens Research, Uniform Financial Analytics.
Specifically, what we're highlighting about Generac, that as-reported returns for Generac are massively distorted. But to understand what this means, we really need to actually understand how we can read this chart specifically. This chart is the chart that anyone lands on the first time they open a company on Valens Research, any company that they choose to look at. It's what we call the PVP chart, or Performance and Valuation Prime. The first chart here is on return on assets, ROA, and we look at the as-reported orange, the distorted orange as-reported ROA for Generac, and we look at the blue, the true uniform accounting blue ROA for Generac. This is about history, right? Up until 2020, this bar here, this is about what the company has done, right? You can see one of the key things that we highlight about Generac is if you look at as-reported metrics for Generac, you'd see, well, it must be a commodity generator producer and have no value add business, because the fact that, quite frankly, anybody could produce a generator. And I'm sure that there are plenty of competitors out there, and that's why it generates a 9% return. In reality, though, what we can see is no, because there aren't a ton of competitors out there, especially that have the solutions that are ready to go solutions they have for individuals, right, in terms of consumers, along with corporates and industrial installations. Because of that, because of the value add they have, and also because the economic moats they have from the research and development they've done, this isn't a 9% ROA business. This is a 35% ROA business, right? As reported metrics understate this company's profitability by 3/4. And that's hugely important because it changes how you think about the business in a big way, in terms of their economic moats, in terms of persistency of their profitability, in terms of where returns have come from. Before we jump into what's going on here, let's look at the rest of the charts though. The second chart is looking at the exact same thing for asset growth. You can think of these first two panels of the performance part of Performance and Valuation Prime, right? Asset growth, we're looking at what is the real true blue uniform accounting asset growth for the company versus the distorted as reported accounting growth for a company. And right, you can see on a distorted basis, there are several years where directionally asset growth is wrong on an as reported basis. You would think the company shrunk in 2015, it actually grew. You would think the company grew at 3% in 2012, it actually grew at 40%. Right? You directly misunderstand how good of a business this is. And right, if we combine these two metrics really are a more thoughtful way for us to present free cash flow. Right? Free cash flow is about cash flows in, cash flows from operations, right, which is the return you're generating on your assets, and cash flow out, the investment you're making in your assets, which really should be investment in things like R&D and CapEx and operating leases, amongst other things. When we see is when we look at it that way, right, the asset growth really represents the cash flow out from investing, and the ROA represents the cash flow in, how profitable the business is. I just look at these two really quick, a 35% ROA and 11% asset growth. I can say on every $100 of assets that Generac has, they're throwing off roughly $24 in free cash flow. That's all about understanding historic performance. Then we look at the valuation side of things, right? First chart we look at is VA prime. What does VA prime stand for? It's value to asset prime. It's really just a cleaned up price to book metric. Instead of price to book equity, which is what the orange distorted as reported metric is for this, we look at price to book assets. Why? Because the fact that we're looking at the total value the market is ascribing to the total business. And that's a price to book metric. And right, what you see is there's a very strong relationship between the price to book a company trades at and the returns the company generates, just intuitively. If a company's cost of capital is, let's say the real cost of capital is 5%, and this company is generating a 5% return, I'm likely to pay the value the company put in to get money from it as an investor. I need a 5% return. You're producing a 5% return on your assets. I'll basically pay book value for the assets. If you're generating a 10% return, 2 times my cost of capital, well, I'll pay 2 times your assets. Why would I do that? Because if I do, your 10% return is 5% in my pocket, right? So value to asset prime tends to have a very strong relationship with ROA relative to cost of capital. Then the next chart is VE prime. What's VE stand for? Enterprise value to adjusted earnings prime, right? It's just a cleaned up PE is really all that it is. And the way to think about it is, right, we have our forward as reported PE, and then we have our uniform accounting adjusted PE. And when we look at that, right, what we're focusing on is what premium, what cap rate is the market ascribing to this company's earnings? How persistent do they think they are? What kind of returns does the market expect? And the last chart here is TSR-R, TSR relative to the market, right? The reason why it's R is because it's the relative. But what does TSR mean? Total shareholder return, or TSR, is the total return an investor can expect to get from the company, combination of capital gains, like appreciation of the stock, and also dividend income, right? And it's R relative to the market because we compare the performance of a company annually to its index. For this case, it's the S&P 500 because this is a US company. When this is flat, that means the company performed in line with the market. When it's down, it means the company underperformed the market. When it's up, it means the company outperformed the market, right? And so what we're focusing on here is understanding, does the market understand this company's profitability? And what we can see is, right, based on when returns are declining and asset growth is shrinking, are the market also, this company underperformed the market? What you'd expect. When returns started to expand and the company started to accelerate growth, TSR outperformed the market, contrary to what as reported metrics would expect you to think happened, because they would make it look like the company's basically flat. But now we want to understand, right, not just the history, but what's the market pricing in the future? And that's really what valuations are about, right? Valuations are about understanding this, not what the company has done, but what the market thinks the company can do, and if you have a divergent opinion, right? When you always look, all the great investors, everyone from Bill Miller to Seth Klarman to Einhorn to even Buffett, everybody else always understands the ideas. The first thing that you have to do if you're trying to identify if you think a stock is undervalued is not think of what you think the company can do, it's understand what the market expects the company to do. Because if market expectations for a company are already for it to be phenomenal, well, even if it is phenomenal, it's already priced in. If market expectations are very pessimistic, then if you just expect things to stay normal, nothing much has to happen except for the market to have a come to Jesus moment, and you can see appreciation. So with that in mind, that's what these lines are for. These first two bars here, the light blue bars, that's what Wall Street sell-side analyst consensus estimates are for the company once we convert them to uniform accounting, right? So Wall Street analysts right now are expecting Generac, who's had returns around, call it 33 to 35%, to be around 30 to 32% the next 2 years. The white bars, that's what the market's pricing in at $101 a share for the stock price for this company. The market thinks that this company that's forecast to have 32% ROAs is going to have ROAs fall to 23%. By the way, even in 2015 to 2017, the worst years for Generac historically, the company never saw ROAs that low. So the market is very pessimistic about this company versus what forecasted returns are. Similarly, what these white bars are what the market expects asset growth to be. And we can see that asset growth of 8%, that's below what the normal trend has been for the last 4 years. So let's just do a quick scenario on Generac. Right, let's say that we think it's going to grow at the rate that it has grown, and we think that returns are going to plateau around 32%. I can do this, right, because we have the embedded expectation tool to do this kind of quick scenario analysis. And if you notice, I just hit this toggle to bring this out so that I can play with it. What happens if I think returns are going to be flat and asset growth is going to be flat? This company is worth 50% more than the market's currently pricing. But let's say you're going to say, hey, you know what? I think that we're going to have a terrible recession because of the coronavirus issues. I also think that everybody's running out of money and nobody's going to spend any money on Generac generators because of that they weren't going to have money to. So I think that they're going to have a significant drop in demand and they're just not going to invest because of that. Well, if you think that this is a reasonable scenario, zero growth for a company that's never grown 0%, and ROA is basically being cut by a third, well, you've got 50% downside here. But what we can do is we can quickly do that scenario analysis to talk through what's realistic based on this kind of analysis. Now, the important thing, though, is we wouldn't even begin to understand this and look at this if we were looking at the as-reported metrics, because we wouldn't be wondering, does Generac have an economic moat to sustain its returns or not? We would say it doesn't because it's a low-return business. As reported metrics would prevent us even from having this intelligent conversation about Generac's business.
Valuations Research, the world's leading source for uniform financial analytics.